Welcome to our deep dive into risk management in hedge funds. Hedge funds are known for their sophisticated investment strategies, but with these strategies comes a unique set of risks and volatility. In this video, we'll explore how hedge funds identify, measure, and manage risk to protect their portfolios and deliver consistent returns. Understanding risk management is crucial for both fund managers and investors, as it forms the backbone of successful hedge fund operation. Let's begin by defining what risk means in the context of hedge funds and why it's so important to address. Hedge funds face a variety of risks, ranging from market risk to operational risk. Market risk involves fluctuations in asset prices, while credit risk relates to the possibility of default by counterparties. There's also liquidity risk, which concerns the ability to buy or sell assets without impacting their price. Operational risk includes failures in internal processes or systems. Each type of risk requires a tailored management approach. By understanding these risks, hedge funds can develop strategies to mitigate their impact and ensure portfolio stability. Market risk is one of the most significant threats to hedge fund performance. To manage this, funds use techniques like diversification, hedging, and asset allocation. Diversification involves spreading investments across various asset classes to reduce exposure to any single market movement. Hedging uses financial instruments such as options and futures to offset potential losses. Asset allocation ensures that the portfolio is balanced according to risk tolerance and investment goal. These strategies help hedge funds navigate volatile markets and protect capital. Credit risk arises when counterparties fail to meet their financial obligations. Hedge funds manage credit risk by conducting thorough due diligence, monitoring credit ratings, and setting exposure limits. They may also use credit derivatives to transfer risk or reduce exposure. By actively managing credit risk, hedge funds can avoid significant losses and maintain portfolio integrity. This process is ongoing, requiring constant evaluation of counterparties and market conditions. Liquidity risk is a concern for hedge funds, especially during market stress. Funds manage liquidity by maintaining cash reserves, investing in liquid assets, and using redemption gates. Cash reserves provide a buffer for unexpected withdrawals, while liquid assets can be quickly sold without significant price impact. Redemption gates limit the amount investors can withdraw at one time, helping to stabilize the fund during turbulent periods. These measures ensure that hedge funds can meet obligations and avoid forced asset sales. Operational risk stems from failures in internal processes, systems, or human error. Hedge funds address this by implementing robust internal controls, regular audits, and staff training. Technology plays a key role, with automated systems reducing manual errors and improving efficiency. Regular audits identify weaknesses and ensure compliance with regulations. Staff training keeps employees informed about best practices and emerging risks. Together, these measures create a strong operational foundation for hedge funds. Quantitative models are essential tools for risk management in hedge funds. These models use mathematical formulas and statistical techniques to assess risk and predict outcomes. Value at risk (VAR) is a popular model that estimates potential losses over a specific period. Stress testing simulates extreme market conditions to evaluate portfolio resilience. Scenario analysis explores different market events and their impact on investment. By leveraging quantitative models, hedge funds gain deeper insights into risk and make informed decisions. Value at risk, or VAR, is a widely used risk metric in hedge funds. It quantifies the maximum expected loss over a given time frame at a certain confidence level. For example, a one-day VAR of $1 million at 95% confidence means there's a 5% chance the fund could lose more than $1 million in one day. VAR helps managers set risk limits and monitor portfolio exposure. However, it's important to recognize its limitations, such as not accounting for extreme events beyond the confidence level. Stress testing is a critical component of risk management. Hedge funds use stress tests to simulate adverse market scenarios such as sudden interest rate hikes or market crashes. These tests reveal vulnerabilities in the portfolio and help managers prepare for unexpected events. By regularly conducting stress tests, funds can adjust their strategies and strengthen their risk control. This proactive approach ensures that hedge funds remain resilient even during extreme market conditions. Scenario analysis allows hedge funds to explore the impact of various market events on their portfolios. Managers create hypothetical scenarios, such as geopolitical crises or economic downturns, and assess how these would affect asset values. This process helps identify potential risks and opportunities, enabling funds to adjust their positions accordingly. Scenario analysis is an ongoing practice, ensuring that hedge funds are prepared for a wide range of market conditions. Diversification is a cornerstone of risk management in hedge funds. By investing in a variety of asset classes, sectors, and geographies, funds reduce their exposure to any single risk factor. This approach helps smooth returns and minimize losses during market downturns. Diversification can be achieved through equities, bonds, commodities, and alternative investments. The key is to select assets with low correlation, ensuring that losses in one area are offset by gains in another. Hedging is a fundamental technique for managing risk in hedge funds. Funds use derivatives like options, futures, and swaps to protect against adverse price movements. For example, a fund holding stocks may buy put options to limit downside risk. Hedging strategies are tailored to the fund's objectives and market outlook. Effective hedging reduces volatility and preserves capital, allowing funds to pursue their investment goals with greater confidence. Asset allocation is the process of distributing investments across different asset classes based on risk tolerance and objectives. Hedge funds carefully design their asset allocation to balance risk and reward. This involves analyzing market conditions, economic trends, and individual asset characteristics. By adjusting asset allocation, funds can respond to changing market environments and optimize portfolio performance. Asset allocation is dynamic, requiring regular review and adjustment. Continuous risk monitoring is essential for hedge funds. Advanced systems track portfolio exposures, market movements, and risk metrics in real time. These systems alert managers to potential issues, enabling quick responses to emerging risks. Technology enhances accuracy and efficiency, allowing funds to manage large, complex portfolios. Risk monitoring is integrated into daily operations, ensuring that risk management remains a top priority. Risk governance refers to the organizational framework for managing risk in hedge funds. This includes establishing risk committees, defining roles and responsibilities, and setting policies. Strong governance ensures accountability and transparency in risk management. Committees oversee risk strategies, review performance, and approve major decisions. Clear policies guide managers and staff, promoting consistent and effective risk practices throughout the fund. Regulatory compliance is a critical aspect of risk management. Hedge funds must adhere to laws and regulations governing their operations, such as reporting requirements and investment restrictions. Compliance reduces legal and reputational risks, ensuring that funds operate within the bounds of the law. Regular audits and reviews help maintain compliance, and dedicated compliance officers oversee adherence to regulation. This protects investors and supports long-term fund stability. Effective risk reporting is vital for transparency and decision-making. Hedge funds produce regular risk reports detailing exposures, performance, and risk metrics. These reports are shared with management, investors, and regulators. Clear, accurate reporting enables informed decisions and builds trust. Technology streamlines the reporting process, ensuring timely and comprehensive information. Risk reporting is an ongoing process, supporting continuous improvement in risk management. Risk appetite defines the level of risk a hedge fund is willing to accept in pursuit of its objectives. This is shaped by the fund's strategy, investor expectations, and market conditions. Managers set risk limits based on appetite, guiding investment decisions and portfolio construction. Clear risk appetite ensures alignment between managers and investors, supporting consistent and disciplined risk management. It's reviewed regularly to adapt to changing circumstances. Setting risk limits is a practical step in managing hedge fund risk. Limits are established for exposures, leverage, and asset concentrations. These boundaries prevent excessive risk-taking and protect the fund from large losses. Managers monitor limits continuously, adjusting them as needed based on market conditions and fund objectives. Risk limits are enforced through policies and systems, ensuring discipline and control throughout the investment process. Leverage amplifies both returns and risks in hedge funds. Managing leverage involves setting limits, monitoring usage, and stress testing leverage positions. Excessive leverage can lead to significant losses, so funds use conservative approaches and regular reviews. Leverage management is integrated with overall risk controls, ensuring that the fund's risk profile remains within acceptable boundaries. This approach supports sustainable growth and protects capital. Volatility is a key factor in hedge fund risk management. Funds analyze historical and implied volatility to assess market conditions and adjust strategies. High volatility may prompt defensive measures, such as reducing exposure or increasing hedges. Volatility analysis helps managers anticipate market movements and protect portfolios. It's a dynamic process, requiring ongoing monitoring and adaptation to changing market environment. Correlation analysis examines the relationship between assets in a portfolio. Low correlation assets reduce overall risk, as losses in one area may be offset by gains in another. Hedge funds use correlation analysis to optimize diversification and manage risk. This technique informs asset selection and portfolio construction, supporting stable returns. Correlation is monitored regularly, as relationships between assets can change over time. Identifying risk factors is a foundational step in risk management. Hedge funds analyze market, credit, liquidity, and operational risks to understand their impact. This process involves data analysis, expert judgment, and scenario planning. By pinpointing key risk factors, funds can develop targeted strategies to mitigate them. Risk factor identification is ongoing, adapting to new market developments and emerging threats. Risk mitigation involves implementing strategies to reduce the impact of identified risks. Hedge funds use techniques such as diversification, hedging, and insurance. Diversification spreads risk across assets, hedging protects against adverse movements, and insurance covers specific losses. Mitigation strategies are tailored to the fund's risk profile and objectives. Effective mitigation supports portfolio stability and long-term success. Risk assessment is the systematic evaluation of potential threats to a hedge fund's portfolio. This process includes identifying risks, measuring their likelihood and impact, and prioritizing them for action. Assessment tools include quantitative models, expert judgment, and scenario analysis. Regular risk assessments ensure that funds remain aware of evolving risks and can respond proactively. This supports informed decision-making and effective risk management. Risk management frameworks provide structured approaches for managing risk in hedge funds. Common frameworks include COSO and ISO 31000, which outline principles, processes, and controls. These frameworks support consistent risk practices, enhance accountability, and improve decision-making. Hedge funds adapt frameworks to their unique needs, integrating them into daily operations. Frameworks are reviewed regularly to ensure effectiveness and relevance. Risk culture refers to the attitudes and behaviors toward risk within a hedge fund. A strong risk culture promotes awareness, accountability, and proactive management. Funds develop risk culture through leadership, training, and communication. Leaders set the tone, staff receive regular training, and open communication encourages sharing of risk concerns. A positive risk culture supports effective risk management and long-term success. Technology plays a vital role in hedge fund risk management. Advanced software and analytics tools automate risk monitoring, reporting, and analysis. These tools enhance accuracy, efficiency, and speed, allowing managers to respond quickly to emerging risks. Technology also supports data integration and visualization, making complex risk information accessible. Hedge funds invest in technology to stay ahead in risk management and maintain competitive advantage. Risk management teams are central to hedge fund operations. Teams include risk managers, analysts, and compliance officers, each with specific responsibilities. Risk managers oversee strategies, analysts conduct assessments, and compliance officers ensure regulatory adherence. Collaboration is key, with teams working together to identify, measure, and mitigate risks. Clear roles and responsibilities support effective risk management and portfolio protection. Effective communication is essential for risk management in hedge funds. Managers share risk information with staff, investors, and regulators through reports, meetings, and briefings. Open communication ensures that everyone understands the fund's risk profile and strategies. It also encourages feedback and collaboration, supporting continuous improvement. Communication practices are tailored to the audience, ensuring clarity and relevance. Policies provide guidelines for risk management in hedge funds. These include procedures for identifying, measuring, and mitigating risks, as well as reporting and compliance requirements. Policies are reviewed regularly to ensure they remain effective and relevant. Clear policies support consistent risk practices and help managers make informed decisions. They also promote accountability and transparency throughout the fund. Training is essential for building risk management expertise in hedge funds. Staff receive regular training on risk identification, assessment, and mitigation techniques. Training programs cover regulatory requirements, best practices, and emerging risks. Ongoing education ensures that staff remain informed and capable of managing risks effectively. Training supports a strong risk culture and enhances overall fund performance. Hedge funds face numerous challenges in risk management, including market volatility, regulatory changes, and technological advancements. Adapting to these challenges requires flexibility, innovation, and continuous improvement. Funds invest in technology, update policies, and enhance training to stay ahead. By addressing challenges proactively, hedge funds strengthen their risk management and maintain competitive advantage. Successful hedge funds demonstrate effective risk management through consistent returns and portfolio stability. Case studies highlight how funds navigated market crises, managed volatility, and protected capital. These stories showcase best practices and innovative strategies, inspiring others to improve their risk management. Learning from success stories supports continuous improvement and long-term fund growth. Risk management failures can lead to significant losses and fund closures. Examples include excessive leverage, poor diversification, and inadequate controls. Analyzing failures helps funds identify weaknesses and improve practices. Learning from mistakes is essential for building resilient risk management frameworks and avoiding future losses. Failure analysis supports continuous improvement and stronger risk control. Risk management in hedge funds is evolving, with new trends emerging regularly. Trends include increased use of technology, focus on ESG risks, and integration of artificial intelligence. Funds adopt these trends to enhance risk management and stay competitive. Monitoring trends ensures that funds remain agile and responsive to changing market conditions. Trend analysis supports innovation and continuous improvement. Hedge funds employ various investment strategies, each with unique risk profiles. Strategies include long-short equity, global macro, and event-driven. Risk management is tailored to each strategy with specific controls and techniques. Understanding the risks of each strategy supports effective management and portfolio stability. Funds adapt risk practices to match their chosen strategies and objectives. Investing in emerging markets presents unique risks, including political instability, currency fluctuations, and regulatory uncertainty. Hedge funds manage these risks through careful analysis, diversification, and hedging. Emerging market risk management requires local expertise and ongoing monitoring. By addressing these risks, funds can capitalize on opportunities while protecting capital. Alternative assets such as private equity, real estate, and commodities introduce additional risks for hedge funds. These include liquidity, valuation challenges, and regulatory issues. Funds manage alternative asset risks through thorough due diligence, diversification, and specialized expertise. Effective management supports portfolio growth and stability, enabling funds to benefit from alternative investment. Derivatives are powerful tools for risk management, but they also introduce complexity and additional risks. Hedge funds manage derivative risks through careful analysis, position limits, and regular monitoring. Understanding the mechanics and risks of derivatives is essential for effective management. Funds use derivatives to hedge exposures, enhance returns, and manage volatility, supporting overall portfolio stability. Fixed income investments present risks such as interest rate changes, credit risk, and liquidity challenges. Hedge funds manage these risks through diversification, hedging, and active management. Interest rate risk is addressed with swaps and futures, credit risk with thorough analysis, and liquidity risk with careful asset selection. Effective fixed income risk management supports stable returns and portfolio protection. Equity investments are subject to market volatility, sector risks, and company-specific events. Hedge funds manage equity risks through diversification, hedging, and fundamental analysis. Sector diversification reduces exposure to single industries, hedging protects against market downturns, and analysis identifies strong companies. Effective equity risk management supports portfolio growth and stability. Commodity investments face risks such as price volatility, supply disruptions, and geopolitical events. Hedge funds manage these risks through diversification, hedging, and market analysis. Price volatility is addressed with futures and options, supply risks with careful sourcing, and geopolitical risks with scenario planning. Effective commodity risk management supports portfolio resilience and opportunity capture. Continuous improvement is essential for effective risk management in hedge funds. Funds regularly review strategies, update policies, and invest in technology to enhance risk practices. Feedback from staff, investors, and regulators supports ongoing improvement. By embracing change and innovation, hedge funds strengthen their risk management and maintain long-term success. Conclusion: risk management is the foundation of successful hedge fund investing. By identifying, measuring, and mitigating risks, funds protect capital and deliver consistent returns. Key strategies include diversification, hedging, quantitative models, and strong governance. Continuous improvement and adaptation are essential in a dynamic market environment. Understanding and mastering risk management empowers hedge funds to navigate volatility and achieve their investment goal.